and we offer a wide range of benefits to our members to help you throughout your career. So we have a lot of time-saving membership benefits that are here to support you, and we can provide individual advice on your contract, employment issues, pay structures and progression, and we have a number of dedicated advisors that will help you through the whole process. So don't worry if you find that your contract, pay, terms and conditions are complicated, because we do have extensive knowledge and expertise in all these areas. Now, you might also be facing challenges with preparing for job planning, reviews and appraisals. We can give you practical help and advice to ensure that you are well prepared, and we can also support you through the acting up arrangement, and this supports and ensures that you are paid appropriately and correctly. Now, we know that you have a wide range of skills and experiences, and we've got the BMJ Learning, and this has an extensive collection of webinars, plus thousands of CPD accredited modules, and some of these modules do just take 10 minutes to complete. And not forgetting that we have the BMJ and the BMA library that has over 22 million ebooks and e-journals all ready to be downloaded to your device for you to use as and when you wish. And we do also have a confidential wellbeing service available to you. This service is available 24/7, and you can talk to a counsellor or, if you wish, another doctor. And this service is also available to your dependents that are aged between 16 and 24. And finally, we do have a Bma Pensions Department to support you, where we do provide assistance and representation to our members in relation to their pensions. So all of these benefits are part of an extensive BMA membership package, and if you're not already a member and you are looking to get joined up, we do have an offer available for this evening, and that's if you sign up tonight, you will receive your first month's membership for free, and you can do this by following the link shown on the screen here. I will also pop my contact details. I can see that there's a couple of questions here on the chat function already. I'll pop my contact details on the side there. If you just want to get in touch with any questions that you've got on BMA membership, I'll be more than happy to help. I will answer the questions that I can here tonight. I'll stick around for another few minutes. But that's all from me. I'll pass back to Phil to continue with the webinar.
Fantastic. Thanks very much, Kirsty. We really
Thanks, Phil.
Thanks,
Kirsty.
No problem.
Appreciate the support, Kirsty, as well. So just before we get started, what I will do is I'm just going to hand you over to Frank, who's one of our specialist medical advisors, just to sort of introduce this evening and talk you through the progress and what's going to happen. Frank, over to you.
Thank you, Phil. Hi, good evening, everybody, and thank you very, very much for joining us this evening on this really exciting presentation on reviewing your personal finances as an SAS doctor. Can you type a message into your message box at the bottom to say that you can hear me, or you've got any questions perhaps as the event goes on from that perspective? I believe you're muted. I've got muted. Is that correct?
I can hear you okay, Frank. Yeah, if anyone can hear us.
Anybody else?
Yeah, Deepak can hear us okay, Frank.
Okay, that's perfect. Okay.
Yeah,
so just to get, excellent. So a few people there. So I believe Haytham is struggling a little bit with hearing me from that perspective. You can hear me now. Okay, perfect. Okay. Thank you, everybody, for your feedback from that perspective. So now you know how this messaging service works. So throughout the evening, feel free to pop a message or a question, and we will try and answer them as we go along. Alternatively, at the end of it, there is an opportunity for you to register initial consultation, and then at that stage, we'll be able to talk through your finances from that point of view. As Phil has already highlighted, I'm one of the financial advisors who specialize in this area, so more than likely we'll be end up having a conversation with from that perspective. So can I pass you back on to Phil? We can crack on, and thank you.
That's great. Thanks so much, Thanks. So yeah, so my name is Phil Bowler, and I'm head of technical support for Vere Medical. So basically, I support the advisors, anything technical like the Nhs Pension Scheme and anything financial that's linked to doctors. What I'm going to do when I go through the presentation, I will switch off my camera. Apologies for my voice. I've got a bit of a cold, typical of kids at school, and straight away passing on their germs to me. But I'll switch off my camera because it just gives you a better view of the slides, I think, so you can read. some of you may have heard the phrase the McLeod judgment. There's a lot on the BMA website. Then I'm going to go through just the basics around pension taxation. Again, because good news, your details on your contract are out today. I understand, again, that's on the BMA website, which hopefully for many of you will lead to a potential pay increase. That could have implications for your pension, which are positive. But you also need to be aware if you will be potentially affected by pension taxation. So I'll explain about that. Then I'm going to finish just talking through a few slides around protection and how that might impact you. So things like income protection, critical illness, and life assurance as a SAS doctor. So the first slide here is just talking about your total reward statement. And I expect many of you have registered for that. You can register it via this a link there, www.totalrewardstatements.nhs.uk, or you can review it via your electronic staff record. And what your total reward statement is, it gives you all personalised information about your employment package, details about things like your remuneration, but it also gives you information about your pension scheme. It gives you a statement about your pension. So before you do anything, if you want to speak to one of our financial advisors, for example, you want to get some element of financial advice, the first thing I recommend you do is make sure you're registered for your total reward statement, and also make sure you print that off so that we can use that in respect to giving advice. Again, apologies for my sniffing. And now I'm going to sort of cover off the basics of the NHS pension scheme. So in effect, the NHS pension scheme, there's two separate schemes, but under one scheme, there are two sections. And so I'm going to start on the far left-hand side with the 1995 section. And if you're just wondering, what pension scheme am I a member of, this will give you some basic ideas. So if you join the NHS pension scheme before the 1st of April 2008, then you would have joined the 1995 section. And how that pension works in very simple terms is, for every year you accumulate in service, you'll get an 80th of your final salary as a pension. So if you've accumulated 20 years service in the NHS pension, you'll have 20 80ths. If you've accumulated 40 years service, you have 40 80ths, i.e. half your final salary as a pension. If you work part-time, say you only work for half-time, then you'll accumulate half a year towards that pension each year. So it'll be 0.5 80ths, if you like, for each year you've accumulated. Now, the positive thing about that pension scheme is the retirement age is 60. So you can retire at age 60 without any kind of penalty, which is fantastic. And it's also an automatic lump sum of 3 times the pension payable, which is tax-free. Now, under that scheme as well, as long as you applied for them before the 1st of April 2008, you could have purchased something called added years. So some of you may have purchased added years, and it was a way of just boosting your pension. It was fantastic value for money. That option is no longer available. Now, for those of you who joined the NHS pension scheme after the 1st of April 2008, before the 1st of April 2015, then you'll be a member of the 2008 section, which is the middle one. That's very, very similar to the 1995 section with some subtle differences. As you see there, it's what we call a 1/60th accrual rate. So we work on the same example I said earlier. If you manage 20 years service, you're 20 60ths. If you manage 40 years service, you'd have 40 60ths, 2/3 your final salary of a pension. Now that sounds better than the 95 section. However, you would have to wait until you were 65 to draw your pension. You can draw it earlier, but there'll be penalties for drawing it earlier. It's around about sort of 5% a year, just as a rough guide for each year you draw your pension early. But if you think about it, you'll be drawing it a year earlier, so you grab your pension for a year longer, and you're paying into it for a year less. That's the reason you have that penalty in place. There's no automatic lump sum, and added years weren't available either at that stage. Although you could have purchased something called additional pension, and that was up to £5,000 of additional pension you could have purchased under that scheme, and that's still available. If you join the pension scheme after the 1st of April 2015, then you would have moved into the care scheme, the career average scheme. That's sometimes known as the 2015 scheme as well. Now that's a very different scheme than the previous two schemes, and that's based on each year of your salary counting towards your pension. So every year of your salary will count towards your pension. It's not your final salary like the 95 and 2008 section. And how it works quite simply is, say for example your income was £54,000, your pension income was £54,000 for the year, you'd get 1/54 of that towards your pension, which would be £1,000, and that would be put into a pot in the background in your pension. And so the next year you earn 54,000 again, you'd get 1/54 of another £1,000 into the pot in the background. So that's £2,000 of pension built up in the background. But also that's been increased each year on a compound basis at a rate of CPI plus 1.5%. CPI being the Consumer Price Index, which is a measure of inflation. So hopefully your pension is staying ahead of inflation. Now with that scheme, there's no retirement age is in line with the state pension age. That's SPA, state pension age. It's a little bit later, it could be 68 for many of you who are on today. So that's a bit of a downside, and there's no automatic lump sum again with the care scheme. The thing with the 2015 scheme, many of you would have moved to that scheme from your 1995 scheme or the 2008 section automatically. And I'll talk a little bit about that again, because that is really the consequences of the McLeod judgment mentioned earlier. I'll go into some detail on that. But individuals who were within 10 years of your normal retirement date on the 1st of April 2012 would have stayed in your previous schemes. You wouldn't have moved those to 2015 scheme. But if you were more than 10 years from your normal retirement date, then you would have moved into the 2015 scheme. And for those individuals who are between 10 years and 13 years and 5 months, that would have been on a taper basis, so sometime in the future. But if you were more than 13 years and 5 months from your normal retirement age, remember on the 1st of April 2012, then you would have moved into the 2015 scheme on the 1st of April 2015. So which means you'll have pension benefits in both schemes. Now I'll touch on the problems with that in a second, because again that's what I'm saying the basis of the McLeod judgment is on. Something now I've written as well, something called ERBO, Early Retirement Reduction Buyout Option. That's also available on the 2015 scheme. And what that allows you is to pay some extra amounts towards your pension in order to take your pension earlier, any age down to age 65. So rather than drawing your pension at state pension age, you could choose to draw at age 65, but you will have to pay an additional premium for that. If that's something you're interested in, by me speak to one of our advisors and just check it's the right thing for you. There are other options available, and you're choosing the right option for your particular circumstances. So I mentioned about the McLeod judgment, and that does have an impact for those individuals who have moved into the 2015 pension scheme. So I'll give you a little bit of background. So as I mentioned earlier, the idea was that following a review of the NHS pension scheme and the fact that it was becoming extremely expensive for the Treasury, so the liability to Treasury was expecting to increase over time because people were living longer, the 2015 scheme was introduced with that state pension age introduced. So that was the idea, was to reduce then the liability to the Treasury. So that was the whole idea of introducing the 2015 scheme. So the normal retirement age was increased on that basis, and obviously it was changed to a care scheme. So that was all fine, and there was no particular issue in respect of introducing that scheme at that stage. However, as part of those reforms, I mentioned about this 10-year period where then all within 10 years of retirement didn't have to move into their benefits into the 2015 scheme. And there's that further protection, that 13 years and 5 months. And that actually caused a problem, because by putting that stipulation within the agreement and within the pension arrangement, that breached age discrimination regulations. Therefore, there's had to be a consultation, because in December 2018, the Court of Appeal found that those reforms unlawfully discriminated against younger members. And it was the judicial and firefighters pension schemes in particular. They were the ones to first bring the case against the government. And obviously, as those are public pension schemes, they're public service pension schemes, as the NHS is, the NHS pension scheme fell into that same group. So it's important to understand that the introduction of the 2015 care scheme in itself is not deemed as discrimination. It's actually that rule about if you were within a certain number of years from retirement and when you would move your benefits to the 2015 scheme or not, as the case may be. So the final judgment for that came down on the 4th of February this year, and Northern Ireland's just come out on the 25th of February as well, following the same rules. And what's come down is to say that basically any member who was an NHS pension member on or before the 31st of March 2012 will be affected by this judgment. And that includes members who are currently active, so if you're still in the pension scheme, deferred, so you might have left the pension scheme for some reason, those who have retired, and those with a qualifying break in service of less than 5 years. Okay, so all those individuals fall into the bracket and are going to be affected. However, it's very clear, it's really very clear to you, you don't have to do anything yourself, you don't have to put any legal claims to be eligible for these changes, they'll just happen. And then if you need to take action, I'm going to explain that in a second. So what's going to happen with your pension? If you have seen, for example, your total reward statement at the moment, you'll have within your total reward statement potentially benefits in the 95 or 2008 scheme and some in the 2015 scheme. But what will happen under this is that all your pension benefits will be put back to your legacy schemes. Legacy scheme, which is your 95 or 2008 benefits for any service between 2015 and 2022. And then when you get to 2022, everybody who's a member of the NHS pension scheme will be moved into 2015 scheme, regardless of your age. But the other thing that's really important to understand is when your benefits physically become payable, you will have a choice whether you'd rather to receive your benefits on the basis of them being moved into your legacy scheme for that 7 years, or whether you think, actually, I will be better off with my benefits in the 2015 scheme. I'd much rather put them back in the 2015 scheme for those 7 years. And you'll have that choice at your retirement date. This diagram should hopefully help to explain it a little bit. And you will get a copy of these slides as well after today's webinar. So you can see there that members in service on or before the 31st of March are in scope. So if you join the pension scheme after the 31st of March 2012, this doesn't affect you. Okay, so if anyone watching you who's in that situation, this doesn't affect you. Your pension benefits will be as they are now. Then you've got the April 2015 to April 2022 period. That's the period that will be affected and when you can choose how you want those benefits, which scheme you want those benefits in. And then when you get to your point when you retire, our red mark, so once you get to retirement, you then have something called DCU, Deferred Choice Underpin, that's what it's called. When you get to that period of time, you can then make the decision of where you want your benefits allocated for that period of time. And you'll obviously try to look at what within your interest to do that. And a pensions agency is supposed to provide you with information at that stage and tell you the details of both options so that you can make the most informed decision at that stage. The biggest issue that's going to come out of this, the most pressing issue, are those individuals who've had annual allowance taxation issues. So some of you may well have had annual allowance taxation issues, some of you may not. But in respect to those who have, you just need to be aware that with the change of putting your pension benefits in the legacy scheme, it's likely that any annual allowance taxation liability will be reduced. So you'll be due a refund. Okay, that's really important. It's also going to be interesting in respect to the new contract. For those individuals who move immediately over to the new contract on the 1st of April, potentially, you could see a spike in your pensionable pay. And that could lead to an annual allowance tax liability. So you may find that you've suddenly got this annual allowance tax liability you've not had before. So just be aware of that. And obviously then you will be affected by this legislation and making a decision around your taxation. But if you do find you suddenly have received an annual allowance statement, which you'll receive in October, if you have any liability, I'd recommend you talk to someone first before taking any action, just to check you really have got a liability, because you can allow for things like carry forward as well from previous years. You go back up to 3 years to look at tax liability. And then it has to be re-established once this becomes law. And that's the important thing, is at the moment, there's nothing to do. There's nothing for you to do at this stage. You will be contacted by the pension schemes, and the changes will take some time to go through. They require new legislation. So at the moment, there's no paperwork, there's nothing to complete. Even for those individuals who are looking to retire in the short term, you'd go ahead and retire and then sort out your situation retrospectively. So it's quite complicated. It's going to be really complicated for yourselves, unfortunately, and for the pensions agency to put this right. It really is. And I mentioned sort of pension taxation. I'm just going to talk very high level the things that you just need to be aware of. And if you think this does affect you, then I'd recommend you do speak to one of our advisors if you haven't had advice already. So what the two main, I suppose, taxation issues you need to think about as a doctor is, first of all, the annual allowance. And the annual allowance at the moment is a figure of £40,000. And what that is the maximum you can fund your pension each year without incurring a tax charge. Now, if you're paying into a private pension, it's just based on the contribution. You can put up to £40,000 into your private pension. But with the NHS, it's slightly different. And it's based on the growth within your pension. And how it works, quite simply, is you look at how much your pension's grown, you then times that figure by 16, add on any tax-free lump sum allowance for that year, and if that exceeds £40,000, then potentially you may have a tax charge. However, you can go, as I said before, you can go back 3 years, look at any unused allowances from previous years, and bring those forwards to try and offset any tax for the current year. There are also issues for those with higher taxable incomes, and I'm just going to touch on that on the next couple of slides. The other tax is the lifetime allowance. Our lifetime allowance is if you like, the cap of what your pension savings can grow to. And that's currently £1,073,100. And recently in the budget, they just announced they're actually going to freeze that cap until April 2026. For those individuals who are affected by the allowance, that's going to cause a bit of an issue and increase any tax liability at retirement. And just to give you an idea of what that means for a doctor, if you were a member of just the 2015 scheme, for example, and you had a pension reaching about £53,655 or above, then you're starting to get a tax charge. If you're in the 95 section, it's £46,657 pension, because you also have the lump sum to build into that scenario. Anything over that, then you'll find yourself with a tax charge. Okay. So if when you get your pension statement, have a look at your see where you are in respect to that, to see if this is something that may affect you. I mentioned about the take annual allowance. I'm not going to spend ages on this, but just to let you know that if you are a high earner for the years 2016-17 to 2019-20, then you may find you have a lower annual allowance than the full 40,000. And a couple of quick checks you need to do. First is something called your threshold income, and that's just adding all your income together from all sources that's taxable. Take off any pension contributions, and if that exceeds £110,000, you then need to check your adjusted income. And your adjusted income is your threshold income you just worked out, plus any pension accrual, i.e. the growth in your NHS pension for that year. If that exceeds £150,000, then you will have a reduced annual allowance. And for every £2 over that, your annual allowance will reduce by £1 down to a minimum of £10,000. So adjusted income of £210,000 or more will give you a reduced annual allowance of £10,000. Now, from the current tax year going forward, that has changed slightly. Threshold income is increased by £90,000, as has the adjusted income, which means that very few doctors are now going to get caught by the tapered annual allowance. So it's much less of an issue. But if you are a really high earner, then you just need to be aware that if your adjusted income is £312,000 or more, the minimum allowance is now being reduced down to £4,000 rather than £10,000. So it's quite significant. If that affects you, then by means, again, speak to one of our advisors. I don't think it'll affect a lot of SAS doctors, but there may be one or two in there that need to be aware of this. So that's pensions and what's happening in the pension world, which is getting quite complicated. Please look out. There's going to be lots of stuff on the BMA website. We'll be doing ongoing webinars as well. Certainly as the McLeod judgment goes into statute, so it becomes law, there'll be things that you may want to do, and keep an eye on how things are progressing, because it would have an impact on your pension. For those of you close to retirement, just be aware that you'll be put in, if you like, a priority pot in respect to sorting out your pension from the McLeod judgment point of view. So now I'm going to talk a little bit about what you need to think about protecting yourself and what the NHS provides you as SAS doctors. I mean, at the moment, hopefully things are starting to settle down. The vaccinations are going really well. In fact, I've got my jab on Friday, which I'm really pleased about. But it's been tough for you guys. But what we're finding quite often is that you haven't thought about yourselves as much as your patients sometimes, and your family, and you need to do that. So this is what this section is really about. Think about PPA, think about people, think about staying at home, think about social distancing, what's going on at the moment. What I want to do is say that you guys have done a fantastic job. We really do applaud our amazing age staff. I really mean that. I'm not just saying that. But you need to think about yourself now. You know, it's never been more important to think about protecting yourself and your family. So take a step back and think about what ifs. And this is what this short section's about. It's thinking about yourself and your situation. And the first thing is to make sure that you've protected your most important financial asset. And that's not your home, that's yourself and your ability to work and earn an income. All that pays for your day-to-day housing costs, pays to support your family, your lifestyle, entertainment, which we hope will come back soon, supports your future plans and aspirations, you know, your children's future education plans. Your income now might be saved in order to pay for your child to go through university or pay for the first deposit on their first house. All these things rely on a stable income. So the first thing you need to think about is, if I'm off sick, what will happen? So first of all, the NHS and sick pay. Well, that chart shows you quite simply that once you've completed 5 years service, you get the full sick pay from the NHS, which is 6 months full pay, 6 months half pay. That's very generous in a general scheme of things. But as I'm sure you're aware, that things do happen and you can be off for longer than 12 months off work. And if you get over 12 months, then what happens at that stage? And for those of you earlier in your careers, you can see there that in fact you've got less support. So if you've only been working for 1 year, you get 2 months full pay and 2 months half pay. So think about the gap in respect if you're off sick long term. So with the NHS, if you remember the NHS Pension Scheme, you could potentially qualify for an ill health retirement pension if you're off long term. There's 2 tiers, and the reason why it's 2 tiers is depending on the severity of your condition or illness. But both severities must be of a permanent nature. And tier 1 is where your assessor has been unable to undertake your current duties. And tier 2 is the assessor has been unable to undertake any regular employment, so a more serious illness, serious condition. And if you're able to claim either of these tiers, then you can claim your ill health retirement pension, which is claiming your pension early without any kind of reduction. So tier 1 pension isn't as generous as a tier 2 pension. The tier 1 pension is any pension you've already earned to date, paid without any kind of reduction. So if you've only been working within the NHS and been in the NHS pension scheme for a short period of time, that is going to be relatively small. It's not going to be a great deal built up at that stage, and it's going to be a lot less than your current income. Tier 2, you get the pension you've accumulated to date, plus you also get an addition. We call it a tier 2 addition, which is like an enhancement. As you can see there, it depends which scheme you're in. So you can see there, for example, in the 95 scheme, you'll get an extra 2/3 of prospective pension service to age 60. 2008 to 65. In the 2015 scheme, you only get half of your prospective pension to normal pension age as an enhancement, but obviously state pension age is later on, so it's still relatively generous. But I would say tier 2 ill health retirement pension is very difficult to claim. You have to be extremely unwell to be able to claim a tier 2 ill health retirement pension, and that still won't provide you with the same level of income, obviously, that you would receive at earning. So think about whether you qualify for that. What's the probability of being able to prove any illness is permanent? You want to probably make sure you're still in control of your own financial future. Even if you are able to claim an ill health retirement pension, you probably still need to make up the difference between that and your previous level of earnings. So I'm going to talk through about how we can help, or how a good financial advisor can help. And the first thing is to advise you around income protection insurance. And it's the most essential of all financial planning tools. It should be essential for every single SAS doctor to ensure they have their income protected. And how that works, quite simply, is ensuring that if you're unable to work and your sick pay finishes, then it will pay an income to you until you return back to work, your normal retirement age, or you pass away. Now, you should look at it as an occupation basis to make sure it protects you if you can't do your own job as a doctor. It's really important because there are income protection policies out there which will pay out, but they'll only pay out if you can't do any kind of job. So they expect you to do some kind of income for some kind of job. But we only recommend the top policies, the quality policies that work on an own occupation benefit basis. Also cover inflation, so index-linked guaranteed premiums. Make sure they can't change it in the future, and make sure that if you do have any cover in place, which I hope you do, that existing cover covers those benefits. Review it, have a look at it. When's the last time you have reviewed your cover? If you've had an increase in wages, has your income protection kept up with that? And obviously with the new contract, it could be a really good time to review your income protection at this stage. But a good financial advisor will talk you through it and tell you what cover you should require and how much that should cost. And again, as independent advisors, we can use the whole marketplace. But from our perspective, we just want to make sure that you're getting good quality financial advice. Now, as protecting your income, all you need to consider, well, there's something here called critical illness. And certainly what that works, the way that works is alongside income protection and life assurance. So most people have it to protect their mortgage. So in the event of you having a serious illness, maybe a heart attack, you have a stroke, then a lump sum's paid out and your mortgage is cleared. So your debts and liabilities are cleared. But what we normally recommend, again, depending on affordability, is you have some extra cover so that you can give you some life, what we call life choices. So it might be that you don't want to return back to work full time when you recover because you might want time to recuperate. It may be your pension's affected because while you're not working, you're not funding your pension. So critical illness can pay out a lump sum which you can help fund extra into your pension to give you that income you've lost while being off sick when you retire. Maybe you have family abroad, you want to go and recuperate with them. And you may need to modify your home. Maybe you can't make going upstairs because of the illness you've had. So you might have to modify your home in that basis. It gives you some cash to make decisions. So it really is, critical illness cover is sometimes sort of underrated, I think. And I get a lot of questions around, does it really pay out? Well, yes, it does. And 2 years ago, there was 97% of all critical illness claims were paid out. It just depends. The only thing to think about is what is a critical illness. But the majority of payments are for things like heart attack, cancer and stroke. But the word critical is important. It is an illness, really, if you think about it, where you're being close to death. And that's the reason why you need that payment to start making some lifestyle changes. But it protects against all those things I said about your pension, other mortgage liabilities, and any changes to your home. The final protection is your life assurance. It's fairly obvious, but the good thing about the NHS is they do provide you with some good life assurance protection for your family. So there's a lump sum payable if you were to pass away as a member of the NHS Pension Scheme, which is 2 times your pensionable pay. It's different depending on which scheme, but it's around about 2 times your pensionable pay. If you work on that basis, you won't be far wrong. But they also provide things like pensions to dependent children, pensions to your spouse or legal partners as well, registered civil partners. So it's really an underestimated benefit, and quite often people opt out of the pension scheme because they think, I don't want to get necessarily a pension. But think about your family. If something does happen to you, that spouse's pension or that partner's pension is really important and can provide that extra bit of security for your family that is quite difficult to provide for yourself. But that isn't necessarily enough in itself. Certainly, we would recommend additional cover for the majority of doctors with families to cover things like future education costs and to make sure that if you were to pass away, your full income is protected. So that anybody, the loved ones you've left behind, don't have to worry about their finances going forward. So, ensure your mortgage and other liabilities will be paid on death or a diagnosis of critical illness. Make sure you've actually calculated any life cover you need and the level of income protection that you require. And give consideration to the NHS pension scheme as well. And that's why it's worth speaking to a specialist advisor, because we'll take all that into account and make sure you're not overinsured as well as underinsured, which is really important. So that just finished. This leads me to finish saying a little bit about Chase Vere Medical before we go to a Q&A session. I think there's quite a few questions coming in, which is fantastic. So as I said before, we are independent financial advisors. We offer a comprehensive range of financial advice services, and they are tailored to doctors as well. We work on a holistic basis, so we've talked about different things, talking about your pension and your protection needs. We can also do savings, investments, inheritance tax planning. There's everything we will do. We'll work on your full circumstances to provide you with the best advice. And the way we do that is through this service model here, which is an introductory meeting where we'll sit down with you for an hour and a half, go through your circumstances in immense detail, gather lots of information from you. And that first meeting, there's no charge for that first meeting. We're not looking to give you really detailed advice at that stage. A lot of it is just getting information from, so we understand your circumstances. From there, we'll then have an idea of what level of advice you would need. You sign to agree to the fact that the level of advice you need and the cost involved at that stage. Until you physically sign to say you're happy with the cost, there is no cost for you. I'll make that very, very clear. But once you're happy with that, you'd sign for that, go away, do the analysis, come back with our recommendations, and hope you look to put those recommendations in place. And regarding costs, if we're looking at protection type policies, life assurance, critical illness, income protection, there's no initial upfront cost from yourselves. It's all included in the product. And if we're looking at other advice, then it may be a fee payable, or it may be a cost within an investment or a savings product. But that will be made very, very clear to you. And then we agree how to review your circumstances going forward. So that just leads me now to get to the stage of bringing Frank back and seeing what questions we've had coming during the period of time. Put the camera back on and ask the slides. Okay. See what we've had question-wise. How are we doing, Frank?
I've got quite a few interesting ones, actually. Thank you very much. And really, really good presentation. So prompted a few questions. I've got one here from Andrew, which is quite interesting. It says, why would you want to consider income protection? Really, really good question. And the reason why it's a good question is typically what happens is when you apply for cover, you apply for income protection at that point, and it's then underwritten at that time. In other words, you were offered terms that if your health was to change after you've got the policy in place, you'd still be covered. But if you ended up with an illness and then say you applied for cover, you would then have an exclusion on it from there. Other things to consider would be diabetes. If you were diabetic, you would not be able to apply for income protection. Something really, really worth considering from that perspective. I'm not saying that people are diabetic, but it is one of those factors that people are unaware of from there. That's that one. Phil, over to you, I think.
Deepak's asked a question. I know you've sort of answered his questions you've gone through, but Deepak's asked a really good question about, he's just asked a question about a penalty if you retire, after 65 in the 2015 scheme. And if you mentioned remember right at the start, I mentioned about ERBO. So the early retirement reduction buyout scheme is there to allow people to retire at age 65 in the 2015 scheme without any kind of penalty. But it is quite complicated. You have to sort of purchase ERBO the moment you join the 2015 scheme, so you can't go back later and buy back previous years. So it can get quite complicated and it can be quite expensive. The thing about all the pension schemes, so just be aware that if you joined after April 2006, then you can retire at age 55. So you can retire early. There will be significant penalties for retiring early. If you joined before 2006, April 2006, you can actually retire at age 50, believe it or not, within the 1995 section. But again, those penalties would be quite significant to do that.
Okay, thanks, Phil. Sarah, you asked a question, which is a penalty, which is a really good question, of course, because when we talk about penalties, we talk about a reduction in your actual pensionable income when you actually get your pension itself. So you say you built up benefits, you're going to receive a pension of £10,000 a year at age 60, but then you decided you wanted to retire at 58 instead. Well, then you would lose 10% of that £10,000 as part of your pension from that perspective. So that's what we're talking about, the penalty itself. So an actual monetary amount that you would lose.
Okay. Anita's asked a question. Again, you've answered this one, Frank, which is fantastic. I'm just going to add one bit to what you've said, because it does apply to a lot of SAS doctors thinking about, why would I join the pension scheme? I'm looking to retire abroad, back with my family maybe. And just be very clear that you can join NHS pension in the vast majority of places in the world. And I always say about this one, the fact that there are forms available on the NHS pensions website, which you have to complete depending on which country you'll be when you retire, so that you can draw your NHS pension. And there's ones for like places like the Solomon Islands, believe it or not. So for there's a whole list of different countries. Have a look on there. Just make sure the country you're planning to retire is on there, and then you can draw your pension. And even if it's not on there, there are still ways you can draw your pension. You just might have to have a UK bank account in order to access that pension. So the fact you are retiring abroad isn't a reason not to join the NHS pension scheme. So just have a look, see what else we've got, Frank. Okay, so Ian has asked, I hope I've got that right, Ina. I'm in a 95 and 2015 schemes. If I retire at 60 on a 95 scheme and don't work anymore, would it have a negative effect on my 2015 pension and state pension? Okay, really good question. I won't have a negative effect on your state pension. Now, if you join your benefits at age 60 from the 95 section, one of the dilemmas you're really going to have is, when do I draw my 2015 pension scheme? And believe it or not, for the vast majority of you, it will make sense to still draw that at age 60, the same term as your 1995 benefits. And the reason why I say that, although you're taking either a penalty or an early retirement reduction, and it will be 7 or 8 years for the majority of people, which seems quite significant. Remember, you won't be contributing to that pension for those 7 or 8 years, and you're already receiving the pension from age 60, although it's reduced, and that will then increase by CPI. So although it won't be quite as much, you're still getting the benefit of that pension, even though it's been paid early. And all that penalty and effect is doing, it's just taking away the effect of you drawing that pension for extra years and the pension age you're not receiving your contribution. You can just leave it and wait until you're 67 or 68 without any penalty, and that's fine, you can do that. But for the vast majority of people, from a financial perspective, it is well worth thinking about drawing that pension early if you're drawing your pension at age 60 and not continuing to work. And Sarah's just asked, what's the early stage I can retire if I'm in the 2015 scheme? I think we said that earlier, so that's age 55. But obviously there again would be a significant penalty for that.
65, Phil, I think.
No, you can retire from 55 in the 2015 scheme. So if you're talking about ERBO, you can bring your standard retirement age forward to 65. But if you want to early retire, you can early retire from age 55.
Okay.
Just trying to see what else we've got here.
I think we're okay. Okay, I've just picked up another one, Phil. Okay. Do I have any, as an advisor, do I have any top tips regards ideas for, and one of them I believe is worth considering is every tax year, print off your total reward statement and keep a copy of it. So then you have a reference point of going back to every single year. So that's available in August of every tax year, when your total reward statement is going to be issued from there. As time goes on, then you'll have a reference point for it.
Okay. Good question here from Haytham about salary sacrifice, or the car scheme, or salary exchange it's sometimes called. And this is very apt at the moment, because you need to be very careful of the impact it has on your pension. Now, Haytham, you actually said about how does this car scheme affect the pension on the 2015 scheme? Well, from that perspective, it just means for whatever you've sacrificed in order to pay for that car, that won't count towards your pension. So if that car's costing you, I don't know, £5,000 a year, just as an example, it just means your pensionable pay will be £5,000 less. So you'll lose that element of your 154 towards that £5,000. That's the impact on the 2015 scheme. For individuals who have annual allowance issues, so the higher earners, you need to be really careful, because when the salary exchange scheme kicks in, if you continue that for a number of years, it really impacts on the 2008 or 1995 benefits, because then when you decide to stop that arrangement, in effect, you get an increase to your benefits in the 95 scheme. Your final salary shoots up. And the impact of that could mean that you'll end up with an annual allowance tax liability. This will only affect high earners. When I say high earners, probably at the same sort of 90,000 plus. But if it's something you're thinking about and you're just worried about the overall impact, then do speak to us, because there's a lot. I don't know if you follow Twitter at all. The BMA on Twitter mentioned this a number of times, and there are some presentations on just to be careful. The car scheme is fantastic value for money for the majority of individuals, but for those higher earners, it can have a sting in the tail. So just be aware. So just see what else we've got here. So Sarah's asked about accessing a previous TRS statement. So the only latest statement will be available, but if there's any reason why you want a pension statement from a previous year, you can get hold of that, I believe, from the pensions agency, but they may charge you for it. They may charge you £120 for that. So you can check with the pensions agency, but I wouldn't worry too much about getting a previous one at the moment. Especially with the latest arrangements with the McLeod judgment, because your pension statement will look different anyway from next year. So don't worry too much about the previous ones, but keep, as Frank rightly said, from going forward, just keep them going forward so you can keep an eye on how your pension's progressing. I see, Frank, you've applied to that question as well. I should look further down. So well done.
I'm trying. I'm typing away. You know.
Right. Jonathan's asked Jonathan's asked a good question. I've had a mixed career in GP and hospital work. How can I be sure my pension calculations are correct? So, Jonathan, that is the $1 million question. It's really difficult. You must get hold of the pensions agency and check what record they've got of your service, particularly as a GP. And then you need to correlate that with when you've paid out pension contributions. So if you've got pay slips, I don't know if a GP, if you were a salary GP, if you've got a record there of your certificates you submitted for your pensionable earnings. But you need to correlate all that together to then establish what your situation is. But we come across a lot of doctors, and we do spend time with doctors trying to put their pension records right. All I say is make sure you try and get your pension record put right a long time before you retire. And I say a long time, 3 years plus, because if you leave it too long, then you will have issues going forward, and it could end up with you having an incorrect pension paid, or even delaying having your pension paid as well. So try and get it sorted out as soon as possible. But if you need some help in that, speak to ourselves. And if you have got issues, the Bma Pensions Department can help you in trying to track unpaid pension contributions.
Okay, so we have a question from Anne-Marie asking about difficulties. In fairness, you are not alone in any shape or form as a result of that, and it's something that we would actively help you get access to your statements from that perspective, and point you in the direction how you can do it. Typically, the reason behind misstatements is because your record is not held or is not correctly up to date, and we would identify what that is and then let you know and work with you to establish what we can do to get access for you. Yeah.
And for those doctors who have got GP services, there's a lot going on with the GP agency at the moment in respect to trying to get those statements right. And there's a portal that's coming out which will give you access to your pension statements for the last 6 years plus the current year. We told us June coming out in June. Whether that happens or not, I'm not too sure. We're maybe a little bit skeptical about it, but obviously that's probably GP service for your previous service. How that will work, I'm not too sure. But watch this space. A lot of the GP records are slowly being sorted out. There's a bit of an amnesty at the moment trying to get past records and past certificates sorted out. But I appreciate, Anne-Marie, getting GP records right at the moment is very, very difficult. Okay, so I'm just conscious of time now, getting up to sort of 50 minutes. So what I'll do is, I'm going to answer one more question just to finish, and and it just disappeared off my thing. I've got it here. Hold on a second, because it was Deep once asked. This may seem a vague question: why NHS pensions are so complex? What if we compare the NHS pension scheme versus pensions from a company like M&S or John Lewis? Are they more simple? And why would I carry on in the NHS pension? I think Frank mentioned that earlier. I understand the other benefits, but any comments would be great. Right. Well, M&S and John Lewis, I don't know this pensions inside out, but the vast majority of what we call defined benefit pension schemes have stopped now. I'm pretty sure that M&S and John Lewis now offer what we call defined contribution schemes. So they're called group money purchase schemes, and they're nowhere near as generous as the NHS pension. The NHS is one of the few schemes now that is still linked to your earnings. So the care scheme is still generous. At 1/54th basis is extremely generous. So I would carry on with the NHS pension because it is fantastic value for money. It really is. It is complicated. That's the only downside, and I can't apologise for that enough. It is complicated and becoming more complicated. But the benefits it actually produces for doctors at the end of the day is probably the best value for money from a retirement benefit perspective in the whole marketplace. Sorry, Frank, you're going to add something?
I was just going to say it's unlike Marks and Spencer's one. It's not just any pension scheme. Bad gag at this hour of the night, isn't it?
Sorry, that's Frank. That's Frank's humour.
That's my sad humour, thankfully. So it's not just any pension scheme; it's Marks and Spencer's pension scheme.
Okay.
Yeah.
Okay, guys. So what I'm going to say now is, obviously, we've also got another webinar due next month as well, when hopefully I can get a chance to really digest the information from your new contract as well. So look out for that. It will be similar to what we talked about today, but there'll be a bit more detail in there and things that will affect you regarding the new contract, hopefully. So look out for that particular webinar. I'd say is, thanks for your time. Thanks for attending today. Anyone who hasn't had their question answered, we'll have a quick check through. We will arrange for an advisor to get in touch with you just to answer that question for you. So apologies if we've not managed to do that online now. Please stay online for a pop-up. If you'd like to have a meeting with one of our financial advisors, then you'll have an opportunity to organise that in a second. You will get a copy of this webinar sent to you as well. Again, on that copy will be a survey for you to complete to give feedback on how you felt today went. And also an opportunity for you to book an appointment at that stage as well if you so wish. But the most important thing is to make sure you're getting good quality financial advice. Hopefully you found this useful. It just leaves me to say thank you very much for watching this evening. Thanks to Frank as well. Thank you, Frank.
Thank you, everyone. Thanks, Phil.
I look forward to seeing you on one of our future webinars. Good evening.
Excellent. Thank you, everybody. Cheers. Bye.